There are so many investment options for beginners, but where do you start? The biggest misconception about investing is that it is for the elite only and you need a lot of money to start investing. That may have been the case 10 years ago, but not in 2023. All those barriers to entry have been removed by industry technology and development. With all these advancements, there is no excuse for newbies not to invest. Here at Lord Finance we post tips and start building your wealth. We post great content 3 times a week, so don't forget to also tap the bell notification icon. Let's get started. The golden rule of investing is don't lose money. This rule was created by billionaire investment guru Warren Buffett, who amassed a fortune by applying this rule. The best way to do this is to invest at attractive prices when options are undervalued. As a result, you end up paying less than the actual price you get later, leading to serious profits. Avoid short-term investments as they are risky and look for long-term investment opportunities to minimize risk. Warren Buffett made his wealth with long-term investments, not short-term trades. In short-term trading, there are some costs that come in the form of fees and a lot of uncertainty that can lead to big losses. The next step is to build a portfolio plan while you are starting to define your goals for the long run. Where do you want to be financially? What would you desire your net worth to be? Ask yourself such questions beforehand, then create a plan for getting there. Once that is done, identify the investment options that are lucrative and whose return rate would give you the earnings you would wish to have within the given timelines. Use this as your guide when making your investment decisions. The next starting point is paper trading. With paper trading, beginners can build real experience without having to risk real money. This technique allows you to trade and invest in stocks, track profits or losses, and basically do everything you would have done with real money. A lot of platforms will let you practice your skills at no cost at all. Think of this as a training ground before you invest with your real money. As a beginner, buying stock of a single company can be one of the best ways to invest your money. By investing in the right company, you could earn as much as 15% a year. So how does one invest as a beginner? The most important aspect to keep in mind is choosing the right company at the right time. This means you have to research companies by looking at their past performance, their management, and their financial reports. Once you have identified a company that meets your qualifications, don't invest right away, but place the company on your watch list for some time. As you wait, keep an eye on price dips and once the stock price goes down. When investing, it's important to keep your emotions in check. Understand that markets are highly volatile and dips can be experienced by even the best companies. Don't panic or make hasty decisions based on dramatic changes. Instead, wait, be patient, and analyze the situation before making a decision. Don't let fear be the driving force behind your buying or selling decisions. Often, if not always, your emotions are wrong and you are doing exactly what the market wants you to. The beauty of investing today is that you don't need a lot of money. Start with as little as $1,000 and grow your account to tens of thousands of dollars in a short time. Avoid penny stocks when investing safely. Penny stocks are stocks of companies valued at less than $5. These stocks are attractive because they are cheap. However, they are highly volatile and have little to no information about the company. Online. Today there are numerous investing apps that target beginners. Some apps even round up your purchases on credit or debit purchases and invest them in a portfolio. These apps will work like robo-advisors and will help manage your portfolio. If you still want to do it for yourself, there are so many apps that will teach you how to invest. ETFs or exchange-traded funds are quite similar to index funds. They track a specific market index and use the same investing approach as an index fund. These funds also tend to have less fees when compared to mutual funds. The main difference between the two is that rather than having a minimum investment, the ETF is traded throughout the day and has a fluctuating share price. Since they are traded daily like stock, they incur brokerage fees paid in commissions. To really succeed with them, you will need to dedicate a significant amount of time, if not becoming a full-time investor. The easiest way to describe index funds is mutual funds on autopilot. Instead, an index fund will track a specific index like the S&P 500 that holds the stocks of 500 of the biggest companies in America. The S&P 500 fund will mirror the performance of the companies within the category. The expenses are lower as the funds take a passive approach in investing, which involves tracking the overall market index as opposed to having a professional portfolio manager. Just like mutual funds, when you invest in index funds, you're purchasing a chunk of the whole market in a single transaction. Similar to retirement plans are the target date mutual funds. With this investment option, your money will be automatically invested in your estimated pension with the year in mind. A mutual fund is a basket of many investments in which investors buy a portion of the fund. These funds are managed by professional managers who decide how the fund should be invested. Each fund usually follows a specific theme, like equity funds invest in stocks. In most cases, though, eligible mutual funds hold a mix of bonds and stocks. When looking towards retirement, if you plan to retire in 20 years, you can choose your favorite mutual fund and label it as 2042 for the end of the term. The last topic we'll discuss today are robo-advisors. Just as the name suggests, these are robots that offer financial services such as building portfolios and selecting investment options on the investor's behalf. If you don't know much about investing, robo-advisors are a great option. Robo-advisors manage all your investments by using computer algorithms to read trends. Their systems have low overhead costs, therefore the fees they require to operate are relatively lower than hiring brokers to manage your account. It would cost you between 0.25% and 0.50% to use a robo-advisor and between 0.5% to 5% to hire a financial advisor. When you are a newbie and you don't have a lot of money, this is an easy way out. It's a cheaper, more convenient and proven way to invest. Well, that's it for today. We would love to know which option sounds better to you. Give it a thumbs up if you enjoyed it. Make sure you subscribe to and tap the bell icon to get notified whenever we upload a new video. That's all. We wish you all the best in your investment journey.